Falling mortgage rates seem to be bringing some buyers back into the struggling housing market, and that has spurred a rally in home builders and home-related stocks. Lennar, Pulte, KB Home, all up 20% or more so far this year. And the ITB Home Construction ETF, which includes a broad range of housing-related stocks, seeing similar gains. But our next guest thinks maybe the market is overestimating a housing comeback. Diana Olick joining us now with Fannie Mae's chief economist, Doug Duncan. Diana, the floor is yours.
Well, thanks, Tyler, and thanks, Doug, for coming in to see us once again. Good to see you. I want to get straight to your forecast because in the past, your forecasts have been remarkably accurate, and yet what I'm looking at now for 2023 is way off consensus estimates. So I want to start first with single-family housing starts. You are predicting that they're going to drop 25% this year compared with last year after an 11% drop last year, much wider than everyone else's forecasting. And as we just saw, the home builder stocks are rallying. How do you see 25% drop?
Well, at the end of the day, two things are meeting. One is affordability constraint. So you've got first-time home buyers seeing mortgage rates. While they've come down 100 basis points, they're still 200 basis points or more higher than they were even a year and a half ago. At the same time as you've got a supply shortage. But the builders start a house today, it's 9 months or maybe 18 months, depending on their backlog, before it's actually out there as a house to move into. So we still haven't repealed the supply issue. We have, the millennials are not at peak first-time home buyers, but they're constrained by affordability. So we think it will take some time. The Fed's tightening is doing what housing always does, which is the Fed tightens, construction slows, then new home sales slow, then existing home sales slow, and there's a lag until you see that recovery come.
So why are we seeing the builders so high, not just today, but in the last month?
Well, I think it's a recognition by the market that, in fact, we still haven't solved the supply problem, and it's going to be on the back of the builders. Why is that? Because the boomers are doing exactly what they always said they're going to do, which is age in place. And now the Gen Xers never get any airtime, so we'll give them some airtime. They've locked in mortgage rates between 2.5% and 4%. In fact, if you look at the actual outstanding mortgages, 18% of outstanding mortgages are more than 1% and less than 2% below current market rates. 84% are 2% or more below current market rates. Those loans are going nowhere. The people that are owning those houses are not changing house anytime soon.
And that obviously is going to play into the drop you're seeing for existing home sales. You have them down 22% this year, which is going to be a lot for the realtors in the market to absorb. What plays into that? You said it's the sellers not wanting to come onto the market, but there is demand out there. We saw it in December.
Yeah, that's absolutely true. We've been behind on the supply side of the curve since 2012. We came out and said, I think if I remember our announcement, it was 2015, we came out and said the problem now is supply. Because from the great financial crisis, what happened was we went from building 2.2 million homes annualized to 400,000, and we stayed there for 3.5 years, destroying the supply chain. So the builders have been trying to catch up for all that time.
Okay, and just one quick question on prices. You only have them down 4%. Everyone else is looking at 10, 15%. How do you account for that?
Well, if, in fact, mortgage rates come back down, which we have some additional decline in mortgage rates with the slowing of overall economic activity, and you still have that pent-up demand in the millennials, who are by and large salaried people, who are the kind of people who buy houses, each increment of price decline is going to bring some of them back into the market.
Okay, Doug Duncan, we'll see you coming next year. Thanks so much. Back to you guys.
All right, Diana, thanks very much. And Mr. Duncan, thanks to you as well.